the warning that he gave was that, that if you continue this policy, that in the end, it all becomes credit-based consumption, and your productive core of your economy is a fraction of what it needs to be to sustain that level of consumption. And in the end, that it collapses. Now, the way that it is hidden is by understating inflation.
Monaco 64, home of alternative economics and contrarian views. Today, we have our good friend David Jensen. He's a regular guest on the channel. He once warned the head of the Canadian Central Bank, David Dodge, back in 2007, that things were going to fall apart, the financial system. Of course, they didn't heed his warning. And now David is warning about the fact that central banks, they're like, well, he warned in May, he said central bank monetary policy leads to certain collapse. It's just policy. And also recently, he wrote coordinated low interest rate bubbles and market fraud by central banks have destroyed Western economies. And in this article on his Substack, he also says that the central bank magic now ends. David, nice to have you on again.
Nice to be chatting again, Mario. It's always a pleasure.
So could you tell us a little bit about your interaction with David Dodge? He was the head of the Bank of Canada at the time.
Yeah, I did an MBA at UBC, graduated in 1999 from that. And while I was doing my MBA there, University of British Columbia, which is in Vancouver, while I was doing my MBA there, David Dodge was a visiting scholar. And yeah, he had before that, he'd been the Deputy Minister of Finance and Deputy Minister of Health, which is the most senior civil servant. And I was curious really about fiscal policy in the prior time because it didn't make any sense to me. So I used to just drop by his office and, have chats with him. And he was very, very friendly guy, super guy to talk to. And, very casual in his demeanor. There was no pretentiousness. And, I always knew the conversations were about to get interesting because he'd get out of his chair and close the door. And that was always a signal to me that that we were going to hear some information. But so I ran into him, 7-8 years later. I was at the Vancouver Board of Trade speech that he gave. And at the time, the asset-backed commercial paper market had let go. And, his speech was about risk adjustment and, how things were going to proceed on a, the nub of it all was that he said that, there's an adjustment of risk going on. And after this, the markets are going to stabilize and they'll move forward again. And so after his speech, I approached him and I said, I as politely as I could, I said, I have a different perspective. And, the Austrian view, number one, in terms of you can't create growth by leveraging debt. You can't create real growth if you truly account for the cost of money and actual diminishment of the buying power of your currency. It is ultimately just a Ponzi that you're running. I didn't use that word, obviously, with him. But so I wrote this letter and I just said, listen, we've been running this leverage scheme since the late 80s, and that they're pyramiding, piling on debt on top of debt on top of debt. And my concern is that now we're reaching the end of the ability to do this, and there's going to be consequences for the market. And I also introduced the concept of the fact that the gold market was structured in a fashion that you couldn't get true price discovery. And that this is what had been allowing, the Wall Street Journal's famous article about the great moderation, right? It's amazing how inflation has diminished and asset prices are going up. And this is, we've reached this central bank nirvana. in the 1990s, what it really was defining down inflation, right? They changed their definition of price inflation so that um, you had trouble measuring it correctly, and you're always under measuring it. And then they were running looser and looser monetary policy and sending assets to the moon. So, we talked, I don't know, maybe 15 minutes and talked about these things. And then he said, listen, I've got an appointment. And he says, but I want you to contact me with some information, put it in a letter. And his assistant intervened at that point, says, here's my card. He says, send it to me and I'll make sure the governor gets it. And David Dodge it was interesting. He pushes his hand down. He goes, absolutely not. He goes, I want you to send the information directly to me. So I said, okay, I'll do that. And what came out of that was those two letters that you've just buzzed through there on the screen. And I tried to be, documented as clearly as I could in a way that was digestible and, not air quotes conspiracy theorist stuff, right? Because we were getting lots of screaming and shouting at the time in terms of the gold market, but not much light. We were getting a lot of smoke and a lot of heat. So I tried to be as factual as I could. And I sent the first letter to him by registered mail. And I got a letter back from him acknowledging receipt. And the second one I sent to him, I sent by email. And it was interesting. Like, he responded within about a half an hour of receipt of the email. And I remember a friend of mine going, what's the governor of the Bank of Canada doing, sending you emails in the middle of the day? Like, he's got other things to think about. But I think I got his attention. Now, to be fair to him, this speech was September, October of 07, and he retired in February, I think February of 2008. So he was at the end of his tenure. And a central bank hero named Mark Carney took over after that. So, but anyways, that's the quick summary of it. And he responded also to the email and said, thank you. And I'll look into this. But in the end, the under Carney, I sent a pile of emails saying, are you going to respond? And then they passed it off to the prime minister's office. And then I started sending emails to them saying, are you going to respond? And then I got a letter back from Jim Flaherty. Actually, a letter and an email back from Jim Flaherty, who was the finance minister at the time. And the summary of what his note was is that we're very careful that we don't run inflationary monetary policy, with either from the fiscal side or the central bank side. But it totally ignored the point that the definition of inflation is an increase in the money stock, right? Which was the point that I was making, is that you were causing price inflation. You can apparently sequester the price inflation into financial assets and real estate and other things for a period of time. But in the end, it always washes out. And I think that's what we're seeing now, Maria.
Yeah, interesting. You mentioned the money stock, and I've always tried to be really clear on this on my channel, that inflation is the increase in the supply of currency and credit. I don't even like to use the word money because we don't.
Well, and sorry for interrupting, but you have to be careful on the use of money supply versus money stock, right?
Oh,
Because the money supply is the annual change, and the money stock is the currency out. It's really the currency stock
yeah.
that's outstanding, right? So,
Oh, yeah, currency. I like notes and coins. M1.
well, even M2,
Yeah,
you can use whatever your definition, but the stock is the amount that's extant,
yeah.
and
But
the
yeah.
supply is the annual change, right?
Yeah, I mean the change in annual supply, yeah, but I guess supply of money and credit as well. I guess you have the annual change and the stock, I guess. But the reason I mentioned that is that I've seen that we've reached an all-time high for the for the global M2, if you want
Yeah.
to call it. It's at 140 trillion. So I think they haven't learned anything, and they still consider inflation CPI, which is really doctored, as we know.
Yeah.
But I wanted to talk a little bit about silver and gold in relationship to what's going on right now. And you wrote recently here, and I'm going to bring it up, and I really recommend the viewers go to Substack. I'm going to put a link to David's Substack in the description. Uh, he's got really good articles there. And I think it was September 4th. You said coordinated low interest rate bubbles and market fraud by central banks have destroyed Western economies. I totally agree with that. And then I'm skipping here because I really like this part here. And I guess we can go through the whole article, but you said here, where is it? Yeah, central bank magic now ends. And I think if you could please tell us why silver and gold are so important to this magic. And we're speaking here on Friday, September 12th. This interview is coming out on tomorrow, Saturday. But we've got silver, David, right now trading above 42 in the spot price, and gold hovering around 36.50. So yeah, maybe you want to go through that article and talk about the central bank magic. And you wrote magic with a J. Is that the old style spelling?
Well, it's a hat tip to the neo-Keynesian BS that's going on, and it also goes back to some of our favorite Satanists throughout history. That's a term that they use. So, but it is it is complete artifice. I guess we start the view of the entire issue in terms of the Austrian economics analysis, which is, and this has been shown very clearly by Anthony Muller, Mueller. I think I linked some of his work in that article, but he shows very systematically how that if you try to create economic growth by increasing credit, and our monetary system is a debt-based money system, so if you're running loose monetary policy or loose currency policy, you're expanding the credit in the system. And he shows that, if you do this, what you're doing is you're creating consumption before your productive base of your economy has increased. So you're leveraging consumption into a system, and you can't sustain that level of consumption, because as soon as you stop creating the credit, then everything falls back to what the economy could actually produce, and which is still at the old level of consumption. And the warning that he gave was that, that if you continue this policy, that in the end, it all becomes credit-based consumption, and your productive core of your economy is a fraction of what it needs to be to sustain that level of consumption. And in the end, that it collapses. Now, the way that it is hidden is by understating inflation. So if you adjust your true inflation numbers, and then, in that article, I looked at the GDP per capita of the US over 25 years and, referred to Larry Summers, and then also John Williams, who was an economist that had worked on contract for Boeing. All Boeing's economic models collapsed in the 1990s, and they had terrible supply chain problems. And you can imagine that, with like a 747 with millions and millions of part numbers in it, if you mess up your supply chain in terms of your order estimate versus, because you've got to give people 5-year windows in terms of production for these things. And if you get it wrong, you're not going to be able to make the deliveries for your customers. And so when you adjust for stated inflation versus true inflation, and I use just a 2% differential there. Larry Summers had said in a paper, the former Treasury Secretary, he said that that inflation was running twice, was actually 18% in 2022 versus the 9% stated by the BLS and the Fed. So when you adjust the output per capita to see what your economy is really producing, we could see there that the U.S. per capita GDP had actually dropped in 25 years. They had stated it had gone from 50,000 per capita in 2000 to 69,000 in 2025 in Q2. But adjusting the inflation numbers, we could see that you're actually truly getting less per capita out of the economy, and that's because of this the problem that you have when you rely on monetary or currency expansion for consumption, is that you get a misallocation of capital in your economy, and your economy is not producing what it needs to produce. So you end up in the end you're pushing on a, I hate the term pushing on a string, but it's essentially what you're doing. You're trying to create more growth, and what you're just doing is creating more misallocation, and in the end the price inflation comes back to bite you. And that's what we have right now, is that true inflation's running actually more than 4%, and I think it's probably in the 5 to 6% region, on a smooth curve. So we have high price inflation, and we have this continued credit dependency in the economy for it to function, and yet the economy is not performing, and we can see that in the jobs numbers that they've continually been adjusting over the last couple of years here. That after the fact they adjust them for actual job growth, and we can see that even though they're juicing the economy, and if you look at the financial conditions index, I think it's the Chicago Fed or the New York Fed puts out a financial conditions index. We have extremely loose financial conditions right now, and yet they're going to be, and the stock market is obviously soaring because of that. And here we go, that they want to lower interest rates again and provide more debt and more credit into the economy, and that is the reason they're doing that, is the economy's become so addled with debt that it can no longer function without this continual increase of this pyramid scheme that they've been running.
Yeah, and also the financial markets. I mean, and I was going to say that despite all the all-time highs in many assets, they're going to cut rates next week. It's a shoo-in, and they might keep cutting, which seems crazy. In this article, you talk about how you call it the grift, how they faked the gold prices, and also, I guess, to a huge extent, they faked the silver prices. But maybe you could tell us a little bit about how they fake it and why it's unraveling right now. Not just on COMEX, but more importantly, the LBMA, and how important the LBMA is to this whole scheme. So before we proceed further with the interview, I just want to give a shout out to Dirty Man Safe. So with traditional safes, their so-called advantage is that criminals can't break into them. But Dirty Man Safe is different. Its advantage is that it's undetectable, so they can't even try to break into it. And that's only one of the many features of Dirty Man Safe. They provide 3 different sizes, and you can bury your gold coins, silver coins, bars, important documents, jewelry, and anything that's valuable for you. So yeah, Dirty Man Safe is affordable, convenient, provides you peace of mind, confidentiality, and sustainability. So if you want to find out more, there's a link below in the description. It will take you to a landing page, and if you use that link, you get 10% off if you were to decide to buy a Dirty Man Safe. And they ship it to Europe as well, not just the United States.
Yeah, so I mean, there's really 3 loose currency policy or monetary policy, credit increase, and increase in the amount of currency in the system, and they're using the old trick there again, and we've seen it throughout history that, when you run these schemes and continually increase your currency, the amount of currency in the system, that in the end you have collapse coming out of it. But that's the key. It started really with Alan Greenspan, who was appointed to the Fed as the chairman of the Fed in I think August 2007, and just a few months after, the LBMA was created in London.
19,
And
1987. Sorry to interrupt.
yeah, oh sorry, what did I say?
2007.
Oh sorry, 1987. Yeah, so the LBMA was created in, I think it was incorporated in December 87. Greenspan became Fed chairman in August 1987. So yeah, the three elements. The first is the continually expanding the money supply and juicing the economy with added credit. Gold and silver. The second element are warning systems of loose monetary policy. So the LBMA was created, and they started using these promissory notes, as opposed to actual vaulted gold and silver for trading. So they're trading a promise to deliver gold and silver as opposed to having the metal. And the key here is that the cash market in London for gold is for immediate ownership and immediate delivery. And they switched that over to a system where it was just a promise to deliver. And you can expand promises without limit, and that's essentially what they've done, trading a couple times annual gold and silver mine supply every day in the market. And then the third element was to understate inflation. The inflation models were continually dumbed down to the point that they could barely respond. So that's the grift. And the reason this grift is coming to an end is both the physical demand for gold and silver now is overwhelming the paper pricing, the paper price fixing system that they've got in London, which is the largest gold and silver market in the world. And also that the interest rates are starting to rise on the long end of the curve. As you well know, as a bond trader, the central banks control the front end of the curve, or can influence it best. But we're seeing the long end of the curve for like 20 and 30-year bonds, that the yields are running higher. And it's very interesting since the Jackson Hole meeting, that there's been such a small correction in the yields on the U.S. 30-year treasuries. They've barely, if you look on a long enough timeline, you can see there that compared to where they've run over the last 3 years in terms of running higher, that they've barely corrected lower post Jackson Hole, indications that lower interest rates were coming. So that's the end of the grift, Mario. Higher interest rates and gold breaking free of the paper price containment or price fixing system in London.
Yeah, I totally agree. I mean, I started following gold very closely in 2002 because I bought some gold for the first time
Yeah.
after the dot-com bubble burst. I thought it would be wise to get a little bit of gold. And I really started following it closely. I followed GATA, Gold Antitrust Action Committee. They
Yeah.
talked about all this grift, how Larry Summers wrote Gibson's paper on Gibson's paradox. Treated Robert Rubin. They had this strong dollar policy. The only way they could maintain it, though, was through leasing gold many times over and keeping the price suppressed. But like you said, that is ending now because there's so much physical demand, especially from countries outside the Western sphere of influence, it seems. So
Mhm.
I'm sure the viewers are wondering when is all this going to unravel? I personally think we're very close, and I think $50 silver is like the line in the sand for the bankers. And
Mm.
many people don't realize how important silver is for the system. I mean, could you talk about that? And to wrap up, maybe tell us where you think silver is going, and yes, whether a break of 50 is really a serious breach, for this fiat system
Mhm.
or this grift.
Yeah. Well, if we look historically, silver was the primary medium of exchange for day-to-day commerce. So, food, fuel, rent, transportation, historically have not been paid with gold, which I would, equate to like a $20,000 bill, historically in terms of the buying power is the money of kings. And so, I think that the focus has been on gold. It's important, but more importantly, it's been on silver to keep it from competing with this, what I term this garbage government currency, the debt based fiat currency that they want us to use. And so, silver, there's 25 billion ounces still above ground, but it's not. It's like a frozen monolith that is people aren't aware of its value, and therefore it's maintained. It's been held underwater, so to speak, in terms of the ability for the price to give the signals and for people to see the value in it. So what I see happening right now is that we're in the midst of this. We're seeing the long bonds selling off, and we're seeing gold and silver running higher and at an increasing rate of change. And there's every indication that there's very, very little silver in terms of what is I call the free float, and I term the free float in terms of the silver, not the silver above ground that's not held by central banks or ETFs, but it's what is actually available to market in the bar form for settlement of trade in the exchanges. And it's very interesting in terms of the drawdown of silver from the LBMA, and that since basically the late spring, the portion of the silver that's at the LBMA in the LBMA vaults has been almost constant, despite the fact that the price is running and that the lease rates are running higher, the implied lease rates are running higher. So what I'm taking from that is that, listen, we've got much higher prices and a very high implied lease rate, where the 1 year lease rate is now over 5%. And typically it doesn't get anywhere near that level because the traders try to secure metal for a short period of time to meet their obligations. So we're seeing, in all the tenors that the implied lease rate is running higher, and I think the actual lease rate is actually materially higher than the implied lease rate, what it costs you to actually get the bars. But we've been hearing for months now that if you're trying to get physical silver in size, that you've got to wait, and that you do get it in the end, but that there's a wait period. And so what I'm seeing there is that the way the price is running and the way the lease rates are running is that it appears to me that the silver that's held in London that's not owned by ETFs is only got a negligible amount of that that's available to market. And also during the same time, the COMEX vaults have been static in terms of their holdings as well. So what I see from that is that it's a similar situation, that the silver is closely held, and that there's appears to be only a de minimis amount of actual physical silver that's available to the market. And I think that's why these prices are running. The lease rates are surging at the same time that the bond yields are surging higher as well. That bonds are being sold, and I think we're having a reignition of the 1970s trade where bonds were sold, gold and silver were bought, and it can go to enormous levels. And I think because of the leverage of all of the major Western economies, it can spiral out of control quite quickly in terms of the amount of interest that you have to pay on an annualized basis. And we're seeing that now in the UK and France especially, that they've got serious problems now with their debt, and people are in the streets objecting to what is going on.
Have you heard as well that on COMEX, the open interest for the silver contract has gone down quite a bit? And usually when silver is at like multi-year highs or near record highs, uh,
Yeah.
the commercials always increase their shorts. That's a sign that they're covering and they're uncomfortable, right?
Yeah, I mean, let's just check the swap dealers here. Those are the bullion banks. They are the swap dealers. Yeah, they've still got some, over 200 million ounces short. So yeah, and the commercials. Yeah, well, the producer merchants are they're quite short as well. So I would expect, Mario, overall that the open interest will decline, um, as faith in the paper markets is lost. And I would expect to see a slower volume and dropping open interest, pardon me, in the COMEX and in the LBMA as well. I think we're getting to the stage now where, and we're seeing, sorry, one other point is we're seeing strange behavior like the SLV ETF since the beginning of September. The price has been surging strongly, since the beginning of September, and yet we've seen a decline in the SLV by about 8.5 million ounces in the holdings. And what I'm taking from that is these authorized participants, which are the banks, that they're having to go to things like the SLV, which is, I view the SLV as kind of a silver slush fund where only certain people can draw on it. And we heard from Jeff Curry that the ETFs. Jeff Curry was from Goldman Sachs, and he warned us, or didn't warn us. He accidentally stated, I think, in 2021 that the ETFs were selling claims against their client silver that they were holding. And I think that we have no idea how much silver is actually owned or held in London, by these ETFs. And I'm very leery of the LBMA numbers, given the fact that in 2021, for a couple of months there, during the silver squeeze that was going on and the attempt to, force true price discovery, that the LBMA overstated the amount of silver that was in the London vaults by over 100 million ounces. So I think it's really questionable in terms of what the ETFs truly hold in London. We don't know. But we can see a whole series of things that indicate that the silver is not as abundant as as the paper system promoters claim it is. And the key here for the silver, it has to be in the right form, which is these 1,000-ounce bars. It has to be in the right form for delivery on these exchanges. And the price and the lease rates surging the way they are is telling us that it's not as abundant as the paper market promoters claim.
Have you heard that the Central Bank of Saudi Arabia bought into the SLV? They bought like 932,000 shares.
Yeah,
Yeah, I mean that's interesting because they would be able to take delivery of that being a big financial institution, right?
I don't know. I know there was a fund manager that I was in communication with, 15 years ago, who went to, I think it was JP Morgan, and said, I'd like to exchange a basket, these, uh, for silver, it's like 50,000 ounces at a time you can claim it. That's what they call a basket of shares for the GLD. That's BlackRock's, or sorry, that's the iShares ETF for gold. But he had attempted to get delivery, and that JP Morgan told him to go away, basically.
Wonder if the Saudis, Saudi Central Bank knows about this. David, could you tell us what you think is the most important thing for people who are stackers, who are in the miners, because I think things are getting really I think this bull market is going to be very different from the one in the 2000s. Yeah, so your best advice for people, I know it's not financial advice, but like kind of strategy and how to handle the volatility that I think is going to get a lot higher as well.
Yeah, well, my sense of things here is that the central bank magic that I refer to, which is just a leveraged debt Ponzi scheme, um, the bond market is starting to figure out that they're going to be paid with highly depreciated fiat notes in the future, and that the long bond market is starting to see here that this leverage scheme is it's got a compounding interest problem, and the signal that we're getting here in the run into gold and silver, which is a tiny fraction of the 300 trillion or 320 trillion dollars of global debt that's out there. We're getting the signal now that this leveraged Ponzi scheme is entering a failure phase, and as these interest rates run higher, bank assets, which typically 70-80% of their balance sheets are bonds and mortgages and loans of various forms, is that these assets, they're going to start seeing default on these assets and depreciation of the bonds and default on the loans. And the banks can, typically with a 10% loss of assets, the banks become technically bankrupt, 10-12%. And I think that's what's coming, Mario. I think that we've got a monetary system which is driving price inflation and very little actual factual growth in output. And I think what is coming at us at some point is basically the banks are going to get flipped over on their sides as they get the decay in their balance sheet on the asset size. The loans start to default and depreciate. And I think then it's, hate to use the old analogy, but it's musical chairs. Is like what when the music stops, what is the chair that you want to be sitting on that gives you stability in terms of asset value? And I don't see very much more than the farmland, gold and silver, and some other real assets that hold value through these times. When the banks get in trouble, the brokerages get in trouble as well, because they've all got bank accounts. They depend on them to function. And I can't help but mention also, David Webb's great taking is that it looks like these assets are meant to be swept away. And here in Canada, we've got Mark Carney belonging to the World Economic Forum, and they've been pushing this "you will own nothing and you will be happy" concept, which is a Marxist philosophy. And if you don't think that sounds very good, I think it might be time to think about getting assets away from the system, which appears to be on its last legs due to rising interest rates and this, collapse of this pyramid debt scheme.
While you were speaking there, I brought up something that the late Jim Sinclair, he drew he had a cartoon drawn up about the five golden pillars and what would really drive the gold bull market. And we weren't even at 1650. Actually, 1650 was the level that the low that we saw, I think, in 2022 that
Yeah,
we bottomed at. But he said we need these five pillars: a recognized top in the US dollar, which we seem to be getting, trust in USA paper assets declining, bullish general commodity markets, triple deficits of U.S. budget, current account, and trade firmly in place. We definitely have that. And,
yeah,
and this one, we haven't gotten this up until the last 3-4 years.
right.
Recognized top in U.S. Treasury long bonds. So I think that's really interesting. So I think, yeah, I agree with you. We're very close to some kind of event. And you mentioned there David Rogers Webb and the Great Taking. And that's why I tell the viewers I have shares in the gold and silver miners. but you have to basically decide what kind of risk you want to take.
If you trust that things won't be too bad, maybe a share certificate be a
That,
thing called.
yeah, if you can get that from your broker, that is great too.
Yeah.
Uh,
I think Mario, that when this goes visibly sideways, is that there's going to be an attempt to say, well, this is the failure of the market economy. They call it capitalism, but it's truly, a market economy. And we don't have, it's not we don't really have, we don't have a market economy. We've got central planning of interest rates and this bubble blowing by these central planners. And Lynn Rothschild has been pushing this compassionate capitalism, a new model, a new system, along with Mark Carney, who works closely with her. And we don't need a new system. We need these central planners to keep destroying the wealth that is being generated by citizens, and the taking of people's assets through the financial system, and continual diminishment of the buying power of the currency that they're reliant on.
I totally agree with that. And with that, David, I wish you a great weekend. And thank you again for coming on, and we'll keep in touch.
My pleasure. Thank you, Mario.
You're welcome.